If you're listening to this the day it drops, it's Christmas. Merry Christmas. Hope you have a wonderful day. Hey, this is an episode that I recorded on another podcast with Gemma Dale. Gemma works with NAB Trade, and you've heard her here on the podcast before, and her podcast is called Your Wealth. So what you're about to hear is my conversation with Gemma on her podcast, where we answer investing questions from the Retire Right group. Hope you have a wonderful holiday season. Merry Christmas. Here we go.
Hi and welcome to this episode of Your Wealth. I'm Gemma Dale, NAB Trade's Director of SMSF and Investor Behaviour. We spent a lot of time on the investor behaviour component and a lot of time talking about markets on this podcast. But today I am joined by Glenn James of the Money podcast, who is frequently hosting guests like myself, does an incredible job of talking to and with people about the stuff that really matters to them. I talk a lot about markets with investors and with fund managers and so on. Markets are great, super interesting, but often the questions that people really have and the things that matter the most to them are much more structural, much more about planning and preparing so you make the first decisions right. And then you can worry about what you're going to do market-wise after that. So Glenn is a former financial advisor. He has the two podcasts, not just Money, but also one called Retire Right, which is super important, right? That topic of retirement is so critical. He has books. He is well regarded across a whole lot of platforms and has a highly interactive community. Glenn, thanks so much for joining us today.
Thanks, Gemma. Thanks for having me back on the show.
It is always great. And the challenge we have, we could both get talking and then kind of don't get to all the things, right? It's always difficult getting to all the things. But what I love most about what we're going to do today is that you've brought some questions and questions from people who listen to you all the time. They know the broad advice that you give and the broad structure and insight you give into how to set yourself up financially. Either that's in your accumulation stage or before retirement or in retirement. These are the questions that come after that, right? Like the ones that come once you're a little bit set up.
And that's right. And I think it's really good when you ask listeners for questions because you're getting real stuff. And I put in the Retire Right Facebook group, and it's a public group, but you do have to join it. If you do want to join it, just put when it says, where did you hear about it? Just put, I heard Glenn and Gemma, because we'll know that you're not a bot from America or somewhere like that. And so I asked, do you have any kind of investing questions? And because we wanted to talk about investing today, just with some random stuff. And we've picked a couple. I might read the first one and we can chew on that. Question from Eric. What's your thoughts on listed private credit fund ETFs to generate income during retirement? If you agree, what would be the percentage of allocation? The TMD, or the Target Market Determination, recommends as a satellite with no more than 30%, not a core asset. How do you take that one, Gemma?
I love this question so much. So we also get questions that come in via the inbox that we have attached to this podcast. They tend to be very broad. I am interested in Chinese equities. Can you talk about it? I am interested in X and Y. Can you talk about it? And they're very broad. This is such a specific question, and I have many thoughts, and I want to know your many thoughts too. So first things first, private credit, not a new asset class, but a relatively new asset class. And
how would you explain that to someone that you just met in the backseat of an Uber pool? Which I've never caught.
In the backseat of an Uber pool, but okay. Had I just met someone who said, tell me about private credit, what is it? This is the lending that banks don't do to businesses.
Yeah, and it could even be to private citizens.
True.
At a previous firm that I worked at, we had high net worth clients, and there was a solicitor who literally did the contracts with our high net worth, lending maybe $1 million to buy a house or whatever, with its own set of terms, and it was very much not an ETF, and it was very much private, direct individual credit.
Yeah. So this is the lending the banks are not doing. And these loans are issued and managed by professional credit managers. I'm going to say fund managers, but we really mean credit managers, right? That's what they are. And then they have a portfolio of loans. They keep a management fee for themselves and then pay you a return over and above that.
And just for further context, people might say, well, why would a company do this instead of a bank? Well, it's the same reason why they may issue bonds to customers, because there could be less oversight and accountability. It's like, we're just going to pay you X amount, don't ask questions every quarter. We just want the money. We'll pay a little bit higher because of that. So that's kind of where it can fit in. I mean, to the question, I think the fundamentals are there. It's like, well, what is your overall asset allocation during retirement? There is going to be a need for liquidity. I'm kind of like, I was just having a look at this because whenever people say, well, what percentage do I set up my portfolio? This is really cool. If only there were like major funds in Australia that had portfolios with public data that everyone can look at.
Maybe we could have a look at those.
So I just had a look at one of the big funds, their high growth allocation. And I know this isn't the retirement part, but go with me. They've got an allocation to credit. Now, it doesn't say if it's private or, through some other vehicle, but their range is 0 to 20%, but the current asset allocation is 2.6. Another fund had credit of 3%, but the range was up to 23%. They also had liquid defensive assets up to 10%. Maybe there is a bit of private in there, which could be a total of 30%. So, I mean, you can kind of see what others are doing. I just think by default, if the actual product issuer is saying this is a bit spicy, you might not want to have more than 30%. And in this one option, you might go, okay, well, if they're saying 30, I'm going to do 15 or 10.
So here's where I'm going to go with this one.
Yeah.
ASIC has just released a paper looking at the private credit sector. It has been marketed to investors as a relatively safe option. But the thing you always have to remember with any kind of debt is the downside is zero. The downside in equities tends not to be zero. Yes, it's zero, obviously, if the company goes under. But most of the time, you can kind of, even though credit is higher in the capital stack, if the company is a reasonably high quality company, and let's assume that's what you're investing in, your shares don't go to zero that often. With credit, if they decide not to pay you back, and these are higher risk borrowers because they have chosen not to go to a bank, they've gone to a credit manager instead, then there is the risk you don't get paid back. You lose all your money. You want to make sure that the person who's doing that lending is extremely good at it. And really good at managing risk. And there's been a reasonable amount of press. You can look in the AFR in particular about particular private credit managers where there's been some interesting stuff going on. There's also been ASIC coming out going, right, here's some of the practices that we see that we're not super comfortable with. We see loan terms that are not clearly articulated. So it was a 10-year term. You're not paying back as frequently as we would like. We're going to make it a 15-year term now. All sorts of stuff. Chris Joy was on this podcast talking about it, I want to say 12 months ago, right. Some of the risks that he saw. This is not vanilla fixed income stuff.
And that's, yeah, I was going to add there, Gemma, I think the solace of having an active private credit ETF, we know that if you do put 30% into that fund, worst case scenario, 30%, we would hope that everything that they've invested in doesn't go to shat, but there could be some loans within that book that they're buying or trading collapse or not return the money.
Absolutely. And we saw in the GFC where credit managers who'd taken undue risks ended up in really dicey situations. So just be aware, this is not standard fixed income stuff. This is not bonds. It's definitely not bank deposits that are guaranteed by the government. It's definitely not that kind of thing. It is absolutely higher risk credit stuff. If you are not across who the manager is and you've not had a look at their ratings and you don't know if other people are holding them and those sorts of things, I feel like 30% is super high.
Yeah. And that's why I said if they're saying 30, yeah, okay, maybe we'll do a third of that.
Little sleeve,
this is
or
right.
spread it across a number of managers, that sort of thing.
Yeah, and everything's always good until it isn't. That's the problem. And I just had a look at a random active ETF that did private credit. If I was looking at that, I would want to make sure the fund manager has a long-term track record, maybe over 5 years, probably over 10 if possible.
Oh, yeah. Yeah.
And then I was having a look, this fund here to the end of October, the 7-year return was 9.2%. Pretty good for a defensive little pot, right? So I think this is just, it's, and you could say, well, it's defensive, but if I had a portfolio with 70% equities and 30% private credit, that's a higher risk portfolio than 70% growth and 30%, your usual bonds, cash, and fixed interest. So, I think it's just by nature, a satellite is, I used to, when I had my practice, Gemma, if we were tackling on a satellite, you would do it for an extra bit of exposure. It could be an imputation fund, Australian shares in retirement, so you can pick up a little bit more juice on the franking. But we weren't really running satellites in total over 20% from the core, maybe 30 in a pinch. But I think,
so
it's
you,
just cold shower stuff.
When you were a financial planner, worked on the same license that I represented at the time, and we had a very strict rule: anything that was considered a niche product, and private credit at the time would have been considered niche, less than 10%.
Yeah.
So that gives you an idea.
But I'm talking even your total. If you like, I want to run a core satellite approach. Whatever your flavour is for your satellites, maybe cap it at 20 to 30 in total.
But also have that relatively well diversified.
Yes.
So that if you put your money to work with one option that is going to give you the juice, as you say, that you've got some other exposures if anything goes wrong.
Yeah, in theory, some of the, everything's good until it isn't. And when we're in retirement, sure, income is a big consideration. It could be the same thing. Well, we don't understand this enough to do it, so we're just going to run a bread and butter bucket strategy and have 3 years worth of cash, and just any dividends and distributions from the growth stuff will go into the cash bucket and we get on with our life. So it's a good discussion. I think we've probably agreed that maybe less than 10%.
Yeah.
Maybe.
Certainly with one manager.
Yeah.
That feels like ample. And if you want to do more, that's absolutely fine. But do your research on these ones. That's probably my final call on it.
Now, as a working mum who loves her kiddies, and they're just such a joy around school holidays, and we're heading into that time of the year, Fick in the RetireRight Facebook group said, best way to go about it, investing for kids, 10 to 12 years old, minimum 10 years, how to set it up, whose name for tax purposes. Obviously just using pocket money, not borrowing to invest, so no gearing requirements. Wow, have you got all day about this topic?
We get this question all the time, and I do love it. It's a beautiful question, and it's thoughtful, right? I love it. I love the idea of setting kids up this way, particularly, actually, the first thing I'll say, I would love it if you are doing this for children, try to engage them in the process. It's an amazing educational opportunity. And I've had this question a little bit from people recently, but get them involved, right? Just get them seeing what's happening with it and so on, because...
And I think it's age appropriate. I mean, 10 years old may still be just money in savings. Mm-hmm. And then over time, when they enter the teens and start working, I don't know. I think it's really important to keep it age appropriate.
My son is 12, so I'm bang on this kind of age bracket.
Yeah.
And he has said, I would like to buy a share in a company. Bless you. Well done, buddy. And then he says, like Google.
Yes. and Gemma, you're like, excuse me, it's Alphabet.
I think you'll find they've changed their name now, buddy. Yeah. It's cool that kids can see it. I mean, obviously, my husband and I both work in finance. He picks up some stuff. Yeah. But it is interesting. So a couple of things. One, you can't open most investments for someone under the age of 18 in their own name. You don't want to for tax purposes anyway. So for a trading account, if it's NAB trade, 18's the minimum. That's a legislative thing. That's not a NAB trade thing. So the opportunity then is to do something as trustee for, or you consider investment bonds. Does anyone do investment bonds anymore? I don't know if you do.
Yeah. Gen Life have got investment bonds.
Yeah.
And it's funny, investment bonds, they are, in the money world, I think, the product, because not everything is for everyone. And often people lose their hair and light their hair on fire when investment bonds get mentioned. But I think they're the product with the pendulum that swings the most either way, like really, really good or really, really not good.
Yep.
But what I'm thinking on this, I'm going to tell you my favorite type of strategy if Mercury or Venus aligns. And I might actually send you a link. I actually spent quite a bit of time on this, Gemma. And I've got a blog, 6 Ways to Invest for Your Kids.
Oh, I love it.
Yeah.
That's awesome.
So the first one, and I go through the details, in your own name. So let's just build wealth in your own name. And you could set up a little account, with NAB Trade, and it's a second account and it's in your name or your partner's name or joint name. And we're just like, here, little Johnny, here is your investing. Like, done, get on with it, build wealth. We talk about informal trust, that is a little bit controversial and the murkiest when it comes to the ATO, and I don't think many people in the wild are actually doing it correctly, because I'd think to do it correctly you would need the child to have a tax file number. 3 is an education or an investment or an education bond. 4 is in superannuation, and I'll get to that. 5, an informal trust. And the 6th way, Gemma, to invest for your kids is in experiences.
Ooh.
But what I'll go there with the bank account thing, and for kids, it's really important to note that if a minor receives income that's considered unearned, anything over $416 will attract a 66% tax rate, which I'll go out on a limb to say it's pretty high.
Yes.
So that's 65 plus 2% Medicare. And then once that goes over to 1307, it drops back to 45 plus Medicare. So what we need to work out, if a child, and I was just looking on the NAB website before, NAB, they don't state that a child needs a tax file number, and whatever bank you do, they might require the parent to go in with a child if they're under 14, for example. And if they've just got an everyday transaction account, it's not interest bearing, there's probably not going to need a tax file number. Now, if there was a savings account that did generate interest, pretty much at a 4% interest rate, anything over 10 grand, you're starting to potentially fall into, punitive tax rates. So, but what I would probably, my overarching thing when I ask people about this is to just build wealth in your own life. And when age appropriate, if you want to buy your kids a car, give them a house deposit, you set the timing of when you're going to sell down the assets and gift that. But I do get, even if it is in your own name, you can do that split account, which I talked about, and you could flag it as quote unquote their money. It's just cleaner. But one strategy I love this one, and Mercury and Venus has to align. If you are a parent, an older parent, and you want to invest for your kids, and you might be early 50s, late 40s, you could set up a separate superannuation account in your own name, put money into that for the kids, set them with a beneficiary because they're tax and cis dependent. And then if it lands that you turn 65, for example, when the kid's 18 or 22 or 25, whatever that is, you can take that money out and give it to them. Now, sure, there is some Centrelink issues potentially at the time, but I think for most of us who are well under 50, with superannuation the way that it's going, most of us won't qualify for the age pension for a lot longer anyway because of our superannuation assets. But I really like that idea of setting up a separate super fund in your name, because you can take care of the estate planning by putting the kids as a beneficiary. They can still have visibility about this is how it's invested in growth and all this. Sure, turn the insurances off and all that stuff. You'll just have to keep an eye on it and put money in so it doesn't become not active. But I just think that's such a perfect storm. And then if you are over 60 and you have a change of employment, you can withdraw the money tax-free and give it to them. Over 65, still working, you can withdraw the money and give to them. And that can be that's my little favourite strategy.
That's a doozy, and it doesn't get talked about much at all.
No.
Which is interesting.
No, because people light their hair on
that.
fire when they hear superannuation and access. But if you are my sister, her kid far out, Grace is 16 going on 25. For her, it's not going to be a thing because Lauren had the kids when she was quite young.
Yeah.
But for me, investment bonds are really good for a couple of reasons. If you're like Uncle Glenn and you don't want to buy the little snot bags Christmas and birthday presents and you'll put money in an investment bond, my niece and two nephews, they've each got an investment bond, separate account, and I put money in that.
So for someone who's never come across an investment bond, quick rundown, tax paid after 10 years. They have embedded tax, like super, I guess, to an extent.
Yeah, it's kind of a superannuation part 2, isn't it?
Yeah, but it's over a 10-year time frame and you can access them anytime. They are quite, and correct me if there's been any evolution in this space, because I have not looked at them.
No, literally
they're really antiquated products, right?
Yeah, well, they're an insurance policy.
Yeah, they are. But the products themselves and the people who issue them the businesses that issue them they're not contemporary products, right? There's not the kind of stuff that's going to have a sexy website and make you go, amazing, I'm definitely going to get...
Gen Life has improved.
They got an app that gives you like little sprinkles every time you put some money in?
Oh, no, come on.
Not that contemporary?
Not that contemporary. But I think it's probably, we'll step back one step, but for people who had never heard of this, back in the day, you used to be able to get a life insurance policy called an insurance bond. And it's basically the same product as that. But in this day and age, it's the exact same vehicle. So it's not issued in your name and there isn't life insurance inside the bond. There's an investment product. And the maximum tax rate in that investment product is 30%. But often with franking and whatnot, some of these funds, they can really optimize them for under 20% and just check them out. But if you've held them up for longer than 10 years, any withdrawals, no tax applies. So yes, they can be the most savage thing in the world depending on your situation. Usually they're better to hold if you're a higher income earner in the highest marginal tax rate. But for me, the advantage that I've got them is because they fall outside of your estate. On each of the bonds, I've got listed as a beneficiary in the event of my death that 100% of this money goes to Grace, goes to James, goes to Jeffrey. Now, it's my money. If one of those kids turns out to be a little snot bag and I'm like, you're not getting your freaking money, I'll take your name off as a beneficiary, champ, and then it's still my money. And then I've got a note on there, and it's a non-binding note that in the event of Glenn's death, this money goes to the child. It's intended after age 25 for a house deposit or go on whatever that is. So they're really good. Now, if you are thinking, do we get an investment bond for our own kids? Yes, it might be more quote unquote money savvy just to build wealth in your own name or in a super fund. But what it does, it actually just enables a bit of separation for the behavior. And I know so many people who they have kids and they want to put money aside for the kids' future. So many people, once the kids are in school and life's happening, crap, we need a new lounge. Oh, we'll just get it from the kids' bank account. We'll just repay it later. Like it just adds that little bit of distance. And that distance may be worth having something that is, quote unquote, more beneficial for a longer than 10-year turnaround and may not be as tax effective. So that's why the pendulum with these things swing the most, I think.
I think the other comment I would make is that we see tons of clients buying equities and ETFs now specifically for investment purposes for younger people, right? And they'll do it just as, so-and-so as trustee for, right, their trust arrangement.
Yeah.
That makes a lot of sense for the right person. And to your point, it's just it's nominally there for that individual and it's taxed in your own name. Theoretically, you can do what you want with it. It's one of those ones where for them mentally, they've done that piece of work and it does allow them a good amount of flexibility. One thing I will just strongly recommend you avoid, only because this story has just stayed with me. And it was several years ago, a guy came up to me at an event and said, when my kids were young, I bought them each some shares and it was such a great idea and it's ended up being a disaster. And I was like, tell me more about this. Sounds amazing. And he had bought one child CBA shares.
Oh, no.
And 2 years later, bought the second child Telstra shares.
Lucky child one.
Yeah. So one kid was getting a house and one kid was getting a car. It was the most extraordinary story. And you can totally see how it happened, right? Absolutely see how that's going to play out. Please, if you are going to do something for your children, the idea of buying ETFs and something diversified does, after hearing that story, make so much more sense than pinning your ears back on a single stock. In fairness to this guy, ETFs were not widely available back when he did this. It made perfect sense at the time that he did it, and he didn't change his strategy over time for a variety of reasons. I'm so sure CGT was one of them. ETFs are a great solution if this is the kind of thing that you're looking at and you have more than one child to buy for.
Yeah, well, my three niece and nephews, they've got Vanguard Diversified High Growth Fund. All the same, the amounts, the initial deposit was the same, the initial contributions are all even.
Yeah.
And as they become older, I'll be showing them more. And, I think I said to Grace, JB Hi-Fi, well, you inside this, you own a little bit of that and how they make money. You go in there and buy some Apple whatever, they'll make money on that and they'll pay some rent and any profit goes back in. So I think it's an education thing. If anyone does want to learn more about different strategies, my newest book, The Quick Start Guide to Investing, I think there's about 8 different strategies for different ages and stages with all the ways that you can own shares and products in Australia. And really proud to say that it just won 2025 Australian Business Book Awards Personal Finance Book of the Year and the overall Book of the Year. So
yeah, amazing.
It's a really good gift as well. So yeah, we kind of just detail all the structures that you can buy shares in Australia, from bonds, your own name, joint names, trusts, companies, and it's a good bit of detail.
I think that's super helpful, because I will say it is amazing how focused we get on just the market side, because it's super fun and interesting to talk about. But it is absolutely critical to get your structures and your strategy right. And people get really confused about it. It's complex. They don't necessarily want to go and get advice, or if they do go get advice, they may not be particularly valuable clients to a financial planner at this stage of their lives. So having that written down, amazing.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to retireright.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia so they can connect with you wherever you are. That's retireright.com.au and click Get Help.
Now, that's a really, really good segue, Gemma, and I'm glad you put these questions in this order, because it does lead into the next question.
I didn't mean to. We did this well.
From Ignatius, talking about structure. Is there any tax benefits in selling my shares before retiring at age 60 next year and putting them in my super?
Oh,
well,
lots of questions to ask.
Where do you want to start?
Where do we want to start?
I think at the beginning usually is a good place to start.
Sorry?
At the beginning is usually a good place to start.
So, Ignatius, such a good question, but a lot going on here. So I'm interested that you chose 60 specifically. So the age at which you need to be worried about getting more money into super is 65, generally speaking, because it's harder to get contributions in after that date. Under age 65, you've got a bit more flexibility. You can make annual contributions and so on. If you're working or not working, it's irrelevant. So have you already made contributions and maxed out your caps? There are hard limits on how much money you can get into super each year. That's probably the first question. Can you get money in? If you can, how much have you already got in there, and is there much incentive to try to get more in there? And then we can talk about the shares and whether or not you want to sell them and whether or not you want to sell them at this age and consider the time that you're doing it. What are your thoughts?
I think my kind of thoughts are, number one, I hope, before 60, are we thinking that's an age that's tomorrow? Are we celebrating your 59th birthday today? Or is it like, I'm early 50s, what are we doing here?
Interesting.
I'm kind of thinking, and we can just answer this on the merits and the details that what we've got. As a general strategy, as we get older, that kind of date of maybe not being able to work if we're in a heavily manual occupation, like I need to retire because I'm cooked or whatever. You just see people, they just pay more attention. So first and foremost, if you did nothing with the shares outside of super, okay, before retiring at 60 next year. Okay, sorry, I reread that. Yeah, 60 next year, so he's 59. One, is it a tools down, I'm retired, I'm done, or can you maybe work a couple of days a week? And that's just more of that lifestyle, keeping active. There's a lot of benefits to purpose and work and all that. But if Ignatius got more money than God and doesn't need to work, awesome. Let's go with that. So there's a couple of things. What you could do if you had surplus money now, stop putting extra money into your current share portfolio out of super. Like, as you said, let's max out what's available. We can look at the carry forward rule. I always get confused, Gemma. Carry forward, bring forward.
Bring forward and carry forward. I want to say bring forward.
Bring forward is
that's
the one.
3 years of non-concessional.
That's the 3 years, yes. So I want to do the carry forward first. So over the last 5 years, is there a way where you haven't used the cap up to the $30,000 to put some money into super and claim it on your tax in this last working year? That could be a strategy to consider.
And people do that. It used to be much more popular when you had very large concessional contributions. It's actually called deductible contributions back in the day, where you could contribute if you're over 55, more than $100,000 in a single year and claim a tax deduction for it to super. Unfortunately, that finished nearly 20 years ago now, and you can't do that. But you can claim that nearly, 30 now, pre-tax, if you've got CGT to offset, because that's always the question. It's like if you're going to be selling a reasonable portfolio and you've got a lot of capital gains tax, using that deduction is quite attractive.
Also, he has to make sure that his balance is under 500,000. So that's what we don't know as well.
Yes.
But otherwise, some things off the top of my head that I would be considering, and I think Ignatius' advice is probably going to be your friend here paying for some financial advice. What are your other assets? Like, do you have 15 investment properties that are pumping out $200,000 a year of rent? That versus you've just got 500,000 in super, and then next year when you stop working and you did want to sell some shares, your income's going to be low, so there won't be a CGT event. But we're not just. I think you would only be considering this. The Mercury and Venus probably should and need to line up for this, because if you're like, I'm overweight in CBA, I'm overweight in whatever, I do need to do some housekeeping at some stage. We want to sell some, we'll do it when our tax rate after work is lower, and put it into super as a concessional, non-concessional, whatever, or we can use carry forward contributions.
Or you may not have any CGT on them.
That's
because
right.
You've got a whole lot of carry forward losses, for example.
Yep.
Or if you bought Telstra,
yep,
and you've got no gains. So this is a very difficult question to answer.
There's going to be a few
It's
hops,
very much
skips, and
dependent on your
jumps.
situation, Ignatius.
you
I'm
can
sorry. I wish we had a better answer for you. But it's going to be how much do you have in super, how much do you earn, how much you're going to earn next year, how much you're going to have in super next year, how much CGT do you have, or what do your capital gains look like? Have you used your caps before? Are you up against your transfer balance cap? All of those things matter.
And I think it really goes to show, is it a dog of a portfolio that you need to do housekeeping on anyway, or is it all in a Vanguard diversified fund?
Yes, this is true.
Because then you kind of see this as the same question. What are the benefits of selling my investment property before retiring at 60 and putting that money into super? It's the same type of thing. Well, does the property need to be sold?
Yeah.
Or are you just wanting to save on tax? But we know up to that kind of transfer balance cap, call it 2 mil into pension phase, we do want as much money growing tax-free. So there could be, and this is why advice, there could be a scenario where we have to do some housekeeping on the portfolio. We're going to sell it down over the next few years and slowly put the money into super, because we can put money into super up to age 75. So look, lots of moving parts, but it goes back. If you are under 50 or in your 50s and you have paid off your house and you do have excess money left over, what would you do so you're not in Ignatius' position? You may consider capping out super first.
Yeah, 100%.
Because it's easier to cash flow into super over time. But anyway, also do what you want. That's what I say, Gemma.
Good luck. Good luck. Sorry.
All right, Tammy?
It's such a good question, and we do get these questions.
But there's like an
accountants
advisor
and financial planners get these questions.
Yeah.
This is one where advice will.
Yeah. So is there any
probably
tax
pay for itself.
benefits? Potentially, either immediately, long-term, portfolio size is there's probably 15 questions that need to be asked. So,
Yeah.
all right,
you can get to the right answer.
That's right. That's right. What's Tammy have to say? Is it sufficient to simply have one Vanguard International Shares Managed Fund and Vanguard Australian Shares Fund? Or should one consider being a little more diverse?
I love this question. I think this is such a good question.
Well,
because
what would you say to
we have
Tammy?
sold investors on the subject of diversification extremely well, right? I love that people do understand this. I will share a statistic which I find fascinating. If you look at NAB Trade's investor base, the average number of instruments held is 4 for an individual. 4 instruments.
Right.
Which sounds terrible unless you consider
So
that
you got
ETFs.
let me guess, VAS, CBA, Telstra, AIG.
I mean, no, but good guess. But if you are holding ETFs, that shouldn't bother you at all, right? You have got the concept of diversification. You know that you don't need to have 42 different ETFs in order to be diversified. However, do you want to have a crack at this and then I'll have a go?
No, you go.
Okay.
I'll buy it.
It is lovely to have exposure to your home market, and the ASX 200 has a lot of interesting attributes that are not true of other markets, particularly high dividend yield franking credits, right? So that's the stuff that our investors love, and they also love having a lot of exposure to resources. Like for our investors, that's what they care about. If you go offshore, which is where investors have had the most success finding growth realistically in the last 10 to 15 years. Like you look at the markets that have performed the best over the 10 to 15 years, ASX has not been up there. The US has been the absolute standout. It is also nearly 70% of the global benchmark now. And you are so exposed to the fortunes of the Mag 7, it's not funny. So the Mag 7, or the top 10 stocks, let's go beyond Mag 7, top 10 stocks in the US are 40% of the S&P 500. The S&P 500 is nearly 70% of MSCI World. It's unbelievable how undiversified it is now relative to previous periods. What are your thoughts?
Yeah, I think it goes back to every portfolio kind of manager in the world, if they're managing portfolios for their clients, for super funds, your portfolios in a box generally, you just do not see a 50-50 split of Australian and international shares only. Like, you just don't. So that example that I used before of looking at some of the ones that are out there in the wild, like these top super funds, one of the growth allocations, the current strategic asset allocation to Aussie shares is 32% and 40% international. And we really do want things like infrastructure, property. We need this stuff. There might be an argument for a gold holding. I generally, and I show my age, but I don't have a portfolio that is 100% growth.
Oh, interesting. No, neither do we. That's
And
quite interesting.
I would rather a little bit smoother ride, and because if, a lot of, on the Money podcast, we've got a lot of younger listeners who might be under 30. I was working during the GFC, and if you are under 30, you probably haven't seen a major event. And the chances of you selling out and getting scared when shat hits the fan is probably pretty high if past performance of human nature is an indication of future performance of human nature. That's probably an accurate thing. But at least if we can have some correlation in there and some things that could soften the blow, it could keep you invested longer.
So I'll make a comment on the selling when things go to pieces. We don't see that in our investor base much.
Well, you did that episode with me a couple of weeks ago.
Yeah. We just do not see it. Our investors, when the market pulls back, are throwing money at the market as an opportunity to just buy the dip, right? So they love it. But
I'll go out on a limb to say your investors are probably more sophisticated than just going and grabbing a new investment app and playing around.
Look, I'd like to believe that. Obviously, if you're a NAB Trade investor, obviously you're very sophisticated in the non-legal.
Like someone has chosen to go to NAB Trade. Someone has chosen to go to NAB Trade. It hasn't been flogged on every podcast as a sales thing, you know what I mean?
And they also, I think, tend to be marginally more conservative than the average new investor in that they like something that's attached to a bank and the kind of stability that comes with that. Yeah. So I will note that. I will also say, though, that it is really easy to buy the dip if you weren't there during the GFC when you lost money for 18 months. Losing money for 18 months is very different to losing money for 3 weeks.
April 2026, anyone?
Entirely.
Yeah, absolutely.
And it was a 55% peak to trough. It was a long, painful bleed, and people got worn out, and they absolutely did go, I can't take this anymore. But there was also the point that you made, which is they lost their jobs. If you've lost your job, it doesn't matter whether you can tolerate some volatility. If you need the cash, you're going to have to sell. So what we're hoping, Tammy, is that you've got some cash on the side and that you've got enough to cover your expenses if anything goes to pieces.
Tammy might have a listed private credit ETF.
Tammy might have many things. So I like your thinking about further diversification. I think even if you want to be 100% equities, and there are absolutely super funds that give you 100% equity options, and they'll just give you a split of international and domestic, at least think about where you think you might want to be other than the US, a tiny sleeve of other stuff, and Australia, because it is a really tiny sleeve of other stuff. And I am aware that US equities, when they're dominated by the Mag 7, they generate their revenues from all over the world. They're not just US listed domestic companies. It's not like Wells Fargo where they only make money in the US. But, do you want to consider emerging markets? Are you thinking about the rise of Asia tech? Do you want to think about European defense stocks, which have been super popular lately? Do you want to have some other stuff? Do you want to think about small caps? Because that's the other thing. We have a lot of investors who want to look at smalls and mid caps and sort of more interesting things. So I would think there's a lot of cool stuff out there that's not covered by those two ETFs that you might want to contemplate.
There's another fund here that I was looking at. Their Australian, this is their high growth option. Their Australian shares allocation at the moment is 28%. Versus the one that I read before, which was about 31.5%. And their international shares is 38.5 versus 39. So I think if you why not borrow someone's homework as well? That I'm I think it's
These
just
super funds have hundreds of people plus asset consultants, external to the business, doing the work on constructing what they consider to be ideal portfolios on the efficient frontier, all that kind of stuff. The only comment I would make, though, their job is to give you smooth returns over time.
That's right.
Which might not be your goal. Your goal might be to shoot the lights out and then you don't
Smash
mind
and
if
grab
everything
it.
goes to pieces occasionally.
Yeah, you kind of went where I was going to go anyway. Tammy could have 3 other ETFs, right? And be diversified. She might have a property ETF. She might have a bond. She might have AAA or something boring. But has Tammy, and this is where in the book, my whole thing with the book was like, starting and getting invested is easy. Staying invested is the hard part. Now, do you have the will and the might every quarter to set an alarm, go in every first Wednesday of every quarter at lunchtime, go in and rebalance your portfolio? That's right. We're going to get you to actively sell a winner and buy a dog. Can you do that? And if you can't, there is a strong argument to, one, get an investment solution that does the rebalancing for you, or go back to a portfolio in a box. And then maybe tack on some satellites for some, I was going to say fun, but you know what I mean, just for that extra little bit of personal interest.
Yeah. I just think there's a lot of exciting and interesting options out there. You've got 2, which is fantastic. That puts you way ahead of the average person. But do consider, just particularly at the moment, how concentrated that actually is, even by historical standards. That's far more concentrated than those 2 things would have been 10 years ago.
It's so funny. Nick, my friend and colleague who I wrote the Quick Start Guide to Investing with, he was joking. I don't know if he may have even wrote it in the book. He's like, the ASX 200, that's a themed ETF of banks and mines.
Look, they're only 50%. There's some other stuff in there.
Yeah, there is.
Not a lot.
What 15, 20% of CSL, or then
You got a bit. Well, not 20%. Jesus, not anymore.
Yeah, I know.
Tiny little bit now.
That's right. So look, I mean, these are great questions, and I hope that I'm talking like I'm hosting this. This is your podcast.
Yeah,
so where you get 2
host,
podcasters.
Right? So
Yeah. Gosh. Anyway, well, I might hand it back to you if you wanted to chat about anything else, but I think we've probably run our course with people's patience.
We have. No, I want to say thank you so much for bringing the questions. I love it, and it's so valuable to people. What I hope this podcast has done is get people thinking a little bit more about the structural component of what they're doing, not just markets, which I love and we'll talk about all day, every day, but just some of the other elements you might want to add to your thinking about how you manage your money, because it just makes an enormous difference just to get those things right.
And we need to be careful that, a lot of let's just have a look at this. Half of the kind of stuff we've talked about is actual strategy. The other half is tactical and tactics. So Tammy's strategy, I want to build wealth for the long term. Okay, Tammy, what's long term for you? I reckon 25 years. Oh, okay, if only you had a long-term investment fund already set up. Super could be the answer.
Yeah.
And then, so this is where we just need to have a strategy, however small, and then within that strategy, let's look at our tactics and our levers to achieve.
Love it. Glenn James, published author, podcaster extraordinaire, and person who does bring so much value to the wealth conversation. Thanks so much for joining us today.
Appreciate you, and thank you to all your listeners. Bye.
Thank you so much for listening. Also, as always, we love hearing from you. We love getting your questions. As I said, they tend to be very markets focused, but we love that. But you can hit us with all the other stuff too. You can reach us at yourwealth@nab.com.au.
Thanks for listening to today's podcast. If you want to support us, there is one way you can do that. You can send the episode to a friend, a family member, or your group chat if you think those people would find it valuable. We also thank you for leaving a review on Apple or Spotify. If you've listened to this podcast for some time, or if you've read any of my books, you would know that giving and generosity in a financial sense is a big thing in my life. If you think it's time that you are ready to give financially to a good cause, you could head to our website, moneypodcast.com.au/charities to see the charities that we support.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, trading as Retire Right Australia, and Glenn James are authorised representatives of Money Sherpa Pty Ltd, which holds financial service licence 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective licence holders.